This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Seat at the table, an activist investor is added to the GE board. Executives are ousted, potentially signaling a big shift at the company. But investors are downbeat.
Discord in D.C. Republicans squabble with Republicans. So what's going on here? And could the rancor be a stumbling block for tax reform and hence the stock market?
The Price is Right. California's governor signed into law a bill that the pharmaceutical industry railed against. Those stories and more tonight on Nightly Business Report for Monday, October 9th.
Good evening, everyone, and welcome. General Electric had a rough day, and it is on track now for a very rough year. GE's new chief executive is making a lot of changes. He's giving an activist investor who's been pushing for cost cuts a seat on the board. And late Friday, it was announced that several top executives are on their way out, and a new chief financial officer is on her way in. The stock closed at a two-year low amid concerns about what the changes could mean for the company's upcoming earnings due out next week. So far this year, the stock has lost more than a quarter of its value. And that's not good news for a lot of investors who either own it outright or in a mutual fund or retirement account. Morgan Brennan takes a look at the changes at GE.
Shares of General Electric tumbling today after the industrial giant announced sweeping leadership changes. Among the biggest, the departure of CFO Jeff Bornstein, who will be replaced by GE's transportation head, Jamie Miller. It marks the latest example yet of the strategy taking shape under new CEO John Flannery. But the move stunned Wall Street, especially since Flannery had supported Bornstein, at least until recently. Analysts worry it could signal more bad news.
He was viewed as being able to roll up his sleeves with John Flannery, who's the new CEO, to affect change. And so I think there's a concern here that with him leaving, that maybe the underlying earnings of the company is a little worse than expected.
But the C-suite changes are also overshadowing another development, that activist investor Trian Fund will finally join the board. Trian has owned nearly 1% of the company since 2015, when it invested $2.5 billion. Since then, like other shareholders, Trian has lost money. But today it said it continues to, quote, believe that GE represents an attractive long-term investment opportunity with significant upside. The company has struggled to meet key financial targets, and the stock has tumbled by 25% this year. Flannery has begun cutting costs ahead of his first major meeting with investors next month, a meeting that will outline his strategy and include updated financial forecasts.
What investors are looking for from Flannery is a realistic view at 2018 and beyond. You know, for what it's worth, our view is that 2018, again, we will see some sort of reset, but you know, that will come along with, again, a more streamlined, more cost-conscious GE, and we could see growth off that reset.
But GE isn't the only industrial behemoth facing investor pressure. Honeywell has also been reviewing its segments, including its biggest business, aerospace. That company is reportedly poised to announce the spin-off of some assets as soon as this week. For Nightly Business Report, I'm Morgan Brennan.
So let's turn now to Mike Bailey for more on the executive shakeup at GE and what he thinks it could mean for the stock. He is Director of Research at FBB Capital Markets, and he owns GE shares. Welcome. A pleasure to have you here, Mike.
Thanks for having me. So
give me a grade, if you will, on what Mr. Flannery has done in terms of shaking up the executive ranks, and also there's an activist investor now on the board. What do you think?
Yeah, so in terms of grades, we would give GE about a B- in terms of the new management and some of the shakeup. You might say, you know, why not a higher grade? Well, I think we're trying to be fair. So I think in some sense, Flannery, he's done a fairly good job. He's shown some initial nice moves early on. But he's an insider. We think that GE really needs some sort of a major shakeup. So we would have given them a higher grade if they would have gotten an expert from the outside. Having said that, the question is what else has happened? We do like the new CFO. We think she adds some gender diversity. We think in terms of an outsider, she spent nearly 2 decades at other companies. So we think that's sort of the kind of attitude that can maybe shake things up a bit more at GE. And then finally, with Trian coming in, we do think that that's something where they've been involved somewhat for the last couple of years. but we think now is a pretty good time. You sort of got potentially hitting on all cylinders with the new CEO, CFO. You finally have an activist there on the board, so you could actually see some meaningful turnaround here in the near term.
Let's talk a little bit about one of the reasons you say you are overweight the stock. You're comfortable owning it because in part of the 4% dividend. Is the dividend safe?
We think it is safe. If you look historically, GE's done a pretty good job keeping their dividend and actually growing it. They did cut the dividend during the Great Recession. You could argue a lot of companies did, and at that time GE was very different. It was almost a bank, so many banks were in difficulties, and so GE cut their dividend along with some other companies like that. We think at this point a cut is fairly unlikely. Now, there's a couple ways to look at that. Some folks have argued that one of the things that GE might do is break up. So there could be a way you could see sort of a stealth dividend cut. Let's say, for example, GE shaves off parts of the business that aren't doing well, and that new business, perhaps they do trim or reduce the dividend there. But for the bulk of the company, we can get into some of those pieces that are actually doing pretty well. We do think they're going to keep the dividend as is, if not grow it, at least in line with inflation. In your view, is the company more valuable whole or more valuable broken up? We would break it up. Basically, there are three really nice pieces at GE. There's a healthcare business, aerospace, and then power. You have to sort of think utilities. So that's about 3/4 of the business that's doing pretty well. If you look at the stock this year, it's off more than 25%. So you could argue that the street is already basically given up on that other piece of the business that's struggling. So we would look at the company, take a hard look at the financials, and say, okay, you've got three nice businesses here. Let's keep them. Let's grow them nicely. The rest of the business, let's carve it out and perhaps let someone else do sort of a turnaround there. But we think that would be one way of really improving things for shareholders. We will keep an eye on that. Thank you so much, Mike. Appreciate it. Mike Bailey with FBB Capital Partners.
Well, the slide in GE shares today, a drag on the broader market. On Wall Street, volume was light and the bond market was closed on this Columbus Day holiday. The Dow Jones Industrials fell 12 points to 22,761. NASDAQ off 10 and the S&P 500 dropped 4. Some strategists say the market was taking a breather after the big run-up in stocks ahead of the start of earnings season. And as Bob Pisani tells us, there are a few other things investors are watching as well.
The markets were a bit muted today, but there's no shortage of catalysts for investors to watch in the week ahead. Earnings season will kick off this week with Citigroup and JP Morgan reporting on Thursday and Bank of America and Wells Fargo rounding things out on Friday. So as usual, it's the big banks starting earnings season. Third quarter earnings are expected to rise about 4% over last year, and financials are set to suffer the lowest growth rate of any sector. Actually, earnings will be down 6% for the financials, but it's largely because of the impact of Hurricanes Harvey and Irma on the insurers and the reinsurers. The banks aren't going down. Not surprisingly, energy is set to be the biggest gainer this earnings season, led by oil and gas equipment services companies and exploration and production names like Anadarko, Apache, and Cabot Oil and Gas, all of which are rising as oil stays over $50. On the economic front, we'll get minutes from the Federal Reserve's latest meeting, along with data on retail sales, inflation, and consumer sentiment. A lot of people watching that inflation data right now. And the drama in Washington's heating up. Investors are now gauging what the now public feud between President Trump and Senator Bob Corker could mean for the path of tax reform. Senator Corker's support will be critical for tax cuts to go through.
It increases everybody's reservation. I think it does make it somewhat more difficult. But we never have a weekend without a surprise out of Washington.
Finally, keep an eye on the solar stocks. The Trump administration is set to sign a rule to withdraw from the Clean Power Plan tomorrow. Remember, that was Obama's centerpiece bill to fight climate change. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And with tax reform on the line, investors are watching that discord in D.C. that Bob just mentioned a little more closely tonight. Eamon Javers reports from Washington.
President Trump began the day extending an olive branch of sorts, a trip to his Virginia golf course for Senator Lindsey Graham, one of the president's frequent critics up on Capitol Hill. President Trump has called Graham a nut job and a disgrace in the past, but on this Columbus Day, the two men spent several hours together. All that comes after a weekend in which the president engaged in a Twitter feud with Senator Bob Corker on Capitol Hill. On Twitter, the president wrote, "Senator Bob Corker begged me to endorse him for re-election in Tennessee. I said no, and he dropped out, said he could not win without my endorsement. He also wanted to be Secretary of State. I said no thanks. He is also largely responsible for the horrendous Iran deal." The senator fired back, writing, "It's a shame the White House has become an adult daycare center. Someone obviously missed their shift this morning." Later, Senator Corker gave an interview to the New York Times in which he said the president is running the White House like a reality TV show and said he could be putting the nation on the path to World War III. All of this comes at a time when the president's going to need Republican votes up on Capitol Hill for his ambitious tax package and also for a controversial immigration reform proposal.
If attacking members of your own party in the most vicious and personal kind of way is a strategy, it's a strategy I've never seen work, and I don't see it working today in Washington.
There are always distractions. Now, ordinarily when you're in the White House and you're working on your day-to-day issues, the distractions are coming from the outside rather than from the inside. This is a little bit different.
But officials here at the White House say the administration hasn't really lost any votes on the tax agenda or the immigration plan because Corker and the other senators that the president has insulted this year will vote the right way for their constituents, whether or not they've been in a feud with the president. For Nightly Business Report, I'm Eamon Javers at the White House.
Expectations on Wall Street were high that the Trump administration would be able to get a number of its priorities through Congress, but so far that hasn't exactly played out. And the president, frustrated by congressional Republicans' inability to move on health care, said over the weekend that he's open to cutting a 1 or 2 year deal on that topic with Democratic rivals as a way to kickstart reform of the nation's system. In response, Senator Chuck Schumer said he was willing to improve the existing health care delivery system, but not repeal and replace Obamacare.
On immigration, another major part of the president's agenda, the White House is playing hardball, making a number of demands in exchange for any deal to protect young, undocumented immigrants, commonly known as dreamers. According to the New York Times, the president is insisting on a border wall, hiring more border agents, tougher laws for those seeking asylum, and denial of federal grants to sanctuary cities. The Democrats were quick to reject it.
So how will all of the discord in Washington, from hardball on immigration to no health care deal to insulting tweets, impact tax reform and the stock market? Jeff Bush is a partner at the Washington Update and joins us now to discuss. What do you make of all this, Jeff? It certainly is, as Tony Fratto just said, unusual to see the distractions coming from within, not from without.
Oh, you're absolutely right. The GOP has had this problem throughout 2017. Tax reform is a little bit unique compared to the Affordable Care Act repeal and replace effort, though. I think you're going to see a lot more togetherness on the tax reform issue than compared to other issues they've dealt with thus far.
What about health care then?
Healthcare was a different issue. When you have healthcare, you had Republican senators in states that expanded Medicaid. You had Republican governors in those same states, all of which were saying we have citizenry who are going to lose coverage if we change the expansion of Medicaid. So it was a taking away of a benefit, whereas tax reform, if properly positioned from a marketing perspective, should be a broad-based benefit to the middle class and across our country.
What do you make of what Eamon Javers suggested is the sort of internal view in Washington, namely that the GOP members who may squabble with the president personally, whether it's Mitch McConnell or Lindsey Graham or now Bob Corker, when push comes to shove, they will go along with tax reform because they see it as good for their constituents?
I generally agree with that. That was the same philosophy that the Republicans thought they had with the Affordable Care Act repeal and replace, although it got caught up in those other issues. But tax reform, again, I think is a little bit different animal. It's certainly a very complex animal, but there is much more of a cohesive thought around the broad benefits of a tax reform, and even within some moderate Democrats as well.
How much do you think, though, all of this squabbling in Washington is delaying the agenda? I mean, have you put an analysis together at all, Jeff, about like when we might expect some progress, because it keeps getting derailed and pushed back?
It does. That's a great point. We were quite surprised that the Republicans, having had 8 years to talk about the repeal and replace effort, didn't have the replace effort on the table ready for a Republican president to sign. I think that was a missed opportunity. If they could have gotten out of the gates a little bit faster with that issue, we'd be much further down the road as it relates to tax reform. Right now, our best estimate, based on everything we're looking at, is that we're not likely to get tax reform done in 2017. But it's still slightly more likely than not that we'll see some moderate tax cuts this year and then revisit the reform issue in 2018.
Is the market thinking everything is all A-OK, or is it being maybe a little naive? I mean, Senator Corker says we may be leading the way on a path to World War III. That could mess up your portfolio, Jeff.
Well, it certainly would mess up everyone's portfolio, without a doubt. But I think going back one step, the reality is our country has been on this path for some time. The Republicans have drawn this process out. That's not unusual in the president's first year as they get their footing and so forth. But I think the market initially, there was a lift from an idea of a Republican president. But I think that played out pretty much by May. And the market is much more based on fundamentals right now. I'm not saying it's a solid market run. I think it's a little bit fragile. It's looking for opportunities to maybe tweak here and there. But I think overall, it's still on a fundamental trajectory at this point.
Jeff, thank you very much. Jeff Bush with the Washington Update.
Thank you.
And still ahead, California signs into law a bill that the drug industry is not happy with.
Wildfires are ripping through wine country. The governor of California has declared a state of emergency in Napa, Sonoma, and Yuba counties. Thousands of people have been evacuated, homes and businesses destroyed as firefighters try to stop the advance that is being driven by strong winds.
And California's Governor Jerry Brown approved a measure today that will give the state's residents more information on what's driving prescription drug prices. But as Meg Terrell reports, that bill was surrounded by controversy.
The price of prescription drugs was a major campaign issue during the presidential election.
They're getting away with murder. Pharma has a lot of lobbies, a lot of lobbyists, and a lot of power.
But since then, it's been states enacting laws around the cost of drugs. The latest is California, whose Governor Jerry Brown today signed a drug pricing bill into law.
Californians have a right to know why their medical costs are out of control, especially when the pharmaceutical profits are soaring.
The law doesn't control the price of drugs. It requires drug companies to provide notification 60 days before increasing the price of their medicines. The requirement applies to hikes of more than 16% over a 2-year period. It also requires drug companies to provide justification for the hikes and mandates that health insurers report information about drug spending.
Transparency will provide information, but the hope is that by providing that information, making it public, the companies will be less likely to raise the prices in the ways that they have.
Price increases of more than 16% in 2 years are not uncommon, according to the University of Pittsburgh's Dr. Walid Jalad.
We just saw one today. One of the drugs for psoriasis had a 30% increase over the past 2 years, and at just 12% in just this year. So it's happening, and it's happening more and more.
The law focuses on drugs' list price before any discounts are paid to insurers or pharmacy benefits managers. That's one reason the pharmaceutical industry railed against it, with industry group Pharma saying, quote, "There is no evidence that SB 17 will lower drug costs for patients because it does not shed light on the large rebates and discounts insurance companies and pharmacy benefits managers are receiving that are not being passed on to patients." It's California's second major attempt recently to bring legislation addressing the price of medicines. Last year, a ballot initiative, Proposition 61, sought to tie the price of drugs in California to levels paid by the Department of Veterans Affairs. After a strong lobbying effort by the pharmaceutical industry, Prop 61 failed to pass. A similar version of that bill is expected to be voted on in Ohio this fall. Legislation focused on drug pricing has also been passed recently in Vermont, Maryland, New York, and Nevada. On the federal level, there's been less movement, helping contribute to a recent rally in biotech stocks. Congress, though, has several hearings scheduled in the coming weeks on the issue. For Nightly Business Report, I'm Meg Terrell.
Well, Amazon is reportedly getting serious about taking on YouTube, and that is where we begin tonight's market focus. According to CNBC, Amazon is working toward creating more advertiser-friendly initiatives in an effort to compete against YouTube. One potential program could possibly give advertisers more data on what viewers were watching and doing online. Shares of Amazon up a fraction today to $990.99. And Walmart wants to make online returns easier. The retail giant said customers will be able to use the Walmart app to speed up the process, cutting down return time to to 30 seconds. Shares of Walmart up just about 2% on the session to $80.53. Honeywell will reportedly spin off its non-core assets and create at least 2 new publicly traded companies. Reuters says the company will resist calls by one of its influential shareholders to spin off its aerospace unit, however. Honeywell shares were essentially flat at $143.60.
The subprime lender OneMain is reportedly in talks to sell itself in a deal that could be worth about $4 billion. The Wall Street Journal says OneMain is said to be in advanced talk with a number of interested parties, although there is no guarantee of a deal. OneMain shares jumped 10% to $31.82. Bank of America reiterated its buy for Apple. Analysts said the company will surge under President Trump's tax plan, which would make it less expensive for Apple to bring money back to the U.S. from overseas, thanks to a lower repatriation tax rate. Apple shares were up nearly 0.5% to $155.84. And Google's parent, Alphabet, received an experimental license from the FCC to create a network of balloons that would help restore wireless phone services in Puerto Rico after Hurricane Maria wiped out much of the service on the island. Alphabet shares down a fraction to $992.31.
Coming up, televisions may be getting bigger, even as viewing on small phones is on the rise. But first, how commodities and currencies fared today. The bond market closed for Columbus Day. Here's a look at what to watch tomorrow, the largest proxy fight ever. Procter & Gamble shareholders will vote on whether Trian's Nelson Peltz should get a seat on the board there. The world's largest retailer, Walmart, meets with the investment community. Executives expected to outline their strategy for the company. And small business owners will express their confidence or lack of same in the economy with the release of the so-called NFIB survey. That is what to watch Tuesday.
Harvey Weinstein has been fired from the movie studio he founded with his brother. The board, which met yesterday, cited new information about misconduct. The firing happened days after 1/3 of the company's all-male board resigned. Last week, sexual harassment allegations were uncovered by the New York Times, allegations that go back decades from actresses and former employees of the Weinstein Company and Miramax.
Well, the rough patch for movie theater stocks continues. This time, the cause was a soft opening this weekend for the revival of the 1980s sci-fi cult classic Blade Runner. Early estimates put sales at $31 million in box office, less than the $54 million estimate. That weighed on shares of AMC Entertainment, Regal, Cinemark, and IMAX. Cinema stocks have fallen hard this year. A number of high-profile blockbusters have failed to live up to the hype. Digital disruption, of course, looming all over the industry as well.
And that digital disruption is taking things from the big screen and moving them to the little one. And it's changing the entertainment industry as we know it. Julia Borston has more.
By 2020, half of all video viewing worldwide won't be on your TV, but rather on mobile devices. And half of that mobile viewing will be on smartphones. That's a 160% increase in smartphone viewing since 2010, according to a new study by Ericsson Consumer Lab. And the younger you are, the less likely you are to be watching television. In the U.S., over 60% of 16 to 19-year-olds viewing is on demand. That's more than double the amount in 2010, while people in their 60s still spend more than 3/4 of their viewing with live linear TV.
It's first and foremost a demographic shift. So obviously, there's fewer and fewer folks who watch linear TV, and the biggest demographic group are the millennials, 26, 25, 24, and they tend to view content on a mobile basis.
We're already seeing the telcos make big moves to appeal to mobile viewers, turning to content to differentiate their cell service and data, which are increasingly seen as a commodity. That mobile video growth was one factor driving AT&T's Time Warner purchase, recently expanded free HBO to all its unlimited choice mobile subscribers.
HBO is very hot, very popular content with a great creative group. And the important thing for AT&T is, with the acquisition of Time Warner, they're bringing that in-house, so they don't have to write a check to a third party the way T-Mobile is doing for Netflix.
And last month, T-Mobile started offering free Netflix to its unlimited family plan members. As for the future of video viewing, it may lie in virtual reality. The report predicts a third of consumers will be virtual reality users by 2020. But it also finds that people want to see VR headsets come down in price. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And finally tonight, the Nobel Prize in Economics was awarded to the University of Chicago Professor Richard Thaler. He was recognized for his work arguing that people make choices that are often not in their best financial interest.
Economics is based on the assumption that everybody is super rational, has no self-control problems, never has a hangover, saves exactly the right amount for retirement and then invests it perfectly. The rest of the world is nothing like that. We're more like Homer Simpson than we are like Spock from Star Trek. And so really we've built up an edifice, a world, a set of theories that apply to fictional creatures. And we don't really have an economic theory that applies to people.
Thaler's work extends to the National Football League. He found that football teams routinely pay too much for the top draft choices and undervalue the lower ones. The best value in the draft, according to Thaler, the 27th overall pick. And that's how he would spend the $1 million Nobel Prize money he was awarded. He said, as irrationally as possible. Good for him.
Good for him. Congratulations to him as well. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you right back here tomorrow night.